Hey there, Canadian Wealth Secret Seekers. It's Kyle here for another Friday edition of our Secret Sauce episodes. Today, I'm going to be going to the inbox again and pulling up an email from a client with a bit of a struggle trying to figure out what is best given their specific situation for, in this case, it's Mark's spouse who has a operating company and so far has been doing some RRSP contributions. So let me pull it up here on the screen and I'll read it out for those who are listening on the podcast. But the email says, "Thanks, Kyle. Sorry for not replying sooner. We've had a busy couple of weeks, including some unexpected expenses at their rental property. AC and furnace had to be replaced. We totally know how that goes. It's always a wonderful thrill when you get more capital expenditures. And not only does it cost money, but it also hurts your soul a little bit and takes time and effort." It says, "This drain on our retained earnings has slowed us down a bit with making any large financial decisions, as it should. I think the best option would be to contribute between," they were looking at a participating whole life insurance policy to help them with their retained earnings issue, both in trying to help get more of it out through the capital dividend account later in life to the next shareholders, but also to provide some leverageability options for themselves a little later in life for retirement purposes. So it says, "I think the best option is to contribute between $20,000 and $30,000 annually, but we want to make sure there aren't any drawbacks as it relates to our retirement plans as they currently stand. We are still weighing this option. We'll continue the process and hopefully make a decision if this is right for us soon. With it being as big of a financial decision for us as it is, we really want to make sure that this is the right choice. Talk soon, Mark." And 100%, folks, you want to make sure that you have a complete understanding of what it is that you're doing. So Mark, good on you for that. Really important for you to fully understand what's going on. I always like to say, if it doesn't feel like a no-brainer for your situation, then it's one of two things. Either it's not a no-brainer and it means maybe it's not a good fit, or you don't know enough yet. Right? So make sure that at least you understand it well enough so that you can make a decision as to whether it is a no-brainer or not. If you're somewhere in the middle, then you are essentially flipping a coin, maybe rolling a die. I don't know. It depends on the probability and I guess depending how confident you are. So this means that Mark has a little bit more work to do, and that means that's on me as his advisor to help him with these decisions. Now, I want to bring you up to speed, folks, on what's going on currently. So Mark's spouse has been contributing for some time into an RRSP. Now, RRSPs inherently aren't necessarily bad, but it really just depends on what's going on inside of them. So what is actually happening? I want to give you a backstory. Their spouse, Mark's spouse, is very conservative, very risk adverse. Tried to have this conversation saying, "Hey, listen, I think that your RRSP investments actually are in too conservative of a investment or asset mix, that they should actually be focusing more on equities. However, that is not their risk tolerance level. They don't feel emotionally able to make that choice. So that's okay. You work with what you are and what you have, and you don't want to put yourself in a position that you feel uncomfortable with." So even though rationally it makes sense for them to be more equity focused or equity based in their portfolio, I'd probably argue for like a 90-10 split. In this particular RSP, you will see, I have it up on the screen for those on YouTube, but I'm going to read it out for everyone else. I've also blocked out any identifying information. It's not even showing which, investment bank this is with. But this RRSP is 93% in mutual funds, except the mutual fund selection is a balanced fund. A balanced fund is really trying to limit the downside risk, but it also limits the upside risk. But there's still risk, of course. There's still an inherent risk. They try to balance it as best as possible. So this is actually not a great move, especially for those who are well off. They have a long time horizon towards retirement. I believe they have about 15 years or so until this 60 age mark where they were trying to kind of, sort of prepare themselves for. And they've been invested in these funds I'm going to say it says over 10 years here in the account, but if it was at 30,000 per year, then it would be more like 7 years. So we're going to make the assumption it's been open for probably around 10 years. It says that there's about 250,000 in this particular account. Again, 93% of it in this balanced mutual fund, and the rest of it, the other 7-ish%, in a GIC. So again, more conservative as well. And you're going to notice here, it says your personal rates of return. Over the past year, it's been highs, 8.75%. Hey, that's not bad. There's nothing wrong with that, of course. So those equities have really been pushing, and our interest rates are high right now. So your balanced fund is actually seeing some positivity there. But the 3-year return is 3.39%. The 5-year return is 3.78%. The 10-year return is 4.14%. And it says since opening this account, they have 4.14%. So I believe it to be open around 10 years ago. However, I don't know that for certain at this time. And my big issue here with the way this is invested is that return, this average rate of return here, is basically what you're going to get in a well-designed whole life policy with a high cash value. So this is more like a savings tool than an investment, the way they have it invested. So I would be tweaking this towards more equities for certain. However, when we look to the money stuck inside the corporation moving forward, I want to just highlight the comparison of what would happen here if we just kept doing what we're doing here. This is the current plan, is to invest 20,000 to 30,000 into this particular RRSP account, which is a balanced fund, which is going to probably, continue around this high 3s to low 4s number as we see here. And that's not ideal in this particular case. So what I want to do is I actually want to show you what would happen here. And what you'll see up on the screen for those who are with me on YouTube, we're showing basically this $250,000 at age 44. And we're going to take that 4.14% and we're going to use it to compound this over time while adding an additional $30,000 each and every year for the next 15 years. You're going to notice that there's some decent growth going on, right? We're going to see that 250 by year 5 is going to turn to almost $500,000. It's $475,000. By year 10, it turns into $752,000. By year 15, it turns into $1,091,000, so about $1.1 million. And we'll assume that after that year that we're not going to contribute to this thing anymore, and we're actually going to do the opposite. We're going to start to withdraw. So when we look at this and we think about what we can actually withdraw, we're going to try some numbers here, and I'm going to assume a 25% tax bracket. We don't know that to be the case. If this is the only income coming in, then she's probably going to be in a slightly lower bracket. That's worth considering. But right now they're using, they're taking more than $55,000 for lifestyle. So my guess is they're probably going to have other income coming from either the rental property that they had referenced, or maybe other investments, or potentially a corporation. If we can't do something with these retained earnings inside the corporation, there's going to have to start taking out a dividend or a salary from the corporation over time. So we're assuming 25. And when we see that, it looks like we can take out about $55,000 from this RRSP. The balance is going to continue growing at this 4.14% in this balanced mutual fund. We're assuming that the asset mix doesn't change and we just keep going with it because they are conservative. His wife is conservative. That really means the after-tax money in their pocket's going to be about $41,250. She can continue taking out that $55,000 pre-tax or $41,000 post-tax money for, it looks like, from age 60 all the way to, it looks like, age 97 before the RRSP is completely depleted. Now, that's assuming we're taking out that same exact amount. We're at 4.14%, and we carry on doing that, until we run out of money. So will it work at this rate? Of course it's going to work. However, what I want to share with you is that if they were to start now doing the same $30,000 inside the corporation with a participating whole life insurance policy, starting from zero, you're going to notice that by, year 15, and you can see this on the screen, the cash value is going to get up to about, and this is based on last year's dividend scale, right? So that can change, just like her 4.1% might go down a little, it might go up a little. We don't really know exactly. However, this one here is going to be a little more consistent, I would argue, based on last year's dividend scale and the fact that we're just coming out of a very low interest rate environment where the effect of these higher interest rates are going to actually help push up the scale in the next few years for at least the foreseeable future. So it looks like we might have a little bit of a bonus there in terms of some of these illustrations. So with this particular illustration, you're going to see that by age 60, the cash value of this policy turns into about $665,000. And there's an associated death benefit about $1.6 million. And you'll notice that by year 15 or by year 16, if the participant, the owner of this policy, if this insured person were to pass, that 1.2 million of it would come out tax-free through the capital dividend account to shareholders at their leisure. And that means about $418,000 of it would still be left and taxable. But let's see what actually happens here. If we were to actually pull out, keeping in mind that if we were going to leverage this policy for income in retirement, that if we were to start pulling out about $41,250 and we assumed an interest rate of about 5%, what you can see is a loan balance, and we're going to assume this loan balance, we're just going to compound the interest. We're not even going to pay the minimum amount or anything like that. We don't know what interest rates are going to be in 15 or 16 years, but I'm going to assume it's not going to be as high as today, and I'm going to assume it's not going to be as low as in COVID, of course. So we're picking somewhere in the middle, and actually I would say on the high end of the middle. So when you see this, you'll notice that this loan balance is going to continue growing. That can feel scary, but remember your cash value. She's no longer contributing any premiums to this policy. The policy is being funded by the dividend each and every year. So that policy is going to continue to grow. Both the cash value and the death benefit are going to continue to grow. And you'll notice that she's able to pull out the same after-tax income all the way until about age 93, which means technically she's running out of money a few years earlier. However, I want you to consider the fact that this policy is starting today with a balance of $0, whereas the RRSP currently has $250,000 in it. So basically what this is saying, the RRSP has a $250,000 lead on the insurance, and it's still going to almost be the same amount, okay? And specifically, I wanted to share here, if we were to look at, the first 7-ish years that she's contributed $30,000, this would have been over the last 7 years. So leading up till now to get about $250,000, it'd take about 7 years at that same 4.14% to get to that place. And basically, if we were to do that for a total of 15 years, you'd have a total RRSP of $632,000. Well, look at the policy. This is kind of eerie, to be honest, because I had said this on a call with this client. If we look at year 15, I said you're basically getting about the same return on the cash value of a policy inside this balance fund currently in the RRSP. So look at the policy's cash value at the end of year 15 is $632,173, whereas the RSP would be at $632,125. So almost identical. The policy is actually doing slightly better by $50 or something like that. But the point being is that basically what's happening right now is this particular individual is investing in a mutual fund that has essentially the same return on the RRSP funds as a cash value life insurance policy typically would have when designed appropriately for a high early cash value and using paid up additions to help complement. And the difference, though, is that if she were to die earlier than, say, her early 90s or die earlier than her mid 90s, that there would be a death benefit that would pay out to the estate, and it would be in a tax-free manner. The longer you live, and this is for our business owner friends, the less of the retained earnings that you use to fund the policy are taxable. So you'll notice for her, by age 85, if she makes it to 85 or later, the whole $2.8 million of death benefit would pay out through the capital dividend account to shareholders tax-free. Whereas the RRSP, if she was to die at 85, if I look at this RRSP and we look at age 85, the way she's going now, age 85, and remember, this is with a $250,000 head start. She has $545,000 in the RSP after she started withdrawing, as you saw. And that's going to all be taxed in that year of death, meaning that it's going to be like an income of $545,000. So she's going to be losing almost half of it in tax to the estate. So there'd be about $250,000 or so coming back to the estate. So from an estate planning perspective, it makes a ton of sense to be using insurance. But I want to show you what would happen if, let's say, she started this policy 7 years ago. Instead of contributing $30,000 for 7 years in the RSP, what we can see here is a policy. Now, she's going to have been about 37 when she started this. So I've run it for 37. So we're kind of going back in time here. And you'll notice it's the same 30,000 going in, but we're going to fund this thing all the way to age 60, which means that's going to be about 22 years of funding, right? So of course the policy is going to get larger, and we're contributing more over time, this entire time. And what you're going to notice by age 60, contributing the same $30,000 over those 22 years, the cash value is going to be at about $1.2 million, okay, in doing it that way. Whereas the RSP over 22 years is going to probably be somewhere around the same, right? The RSP would be at $839,000. Whereas this one's at 1.2. So it's actually getting better and better in this particular case. We've really tried to hone in on how to design the cash value to grow as rapidly as possible in this particular policy, utilizing our current dividend rates. Alongside that cash value is a $2.8 million death benefit. And if she was to pull that same tax-free income of about $41,000 starting at age 60, she would be able to make it all the way to age 100 and still leave a death benefit of about $2.9 million to the estate, with that loan balance of $5.5 million being paid out by the death benefit, because that death benefit has risen to $8.4 million or $8.48 million. And all $8.48 million of it will be credited to the capital dividend account inside the corporation, so that shareholders are able to pull up to that amount out tax-free in that year and future years. It's really up to them when and how they do it, noting that the insurance will only be giving them about a $3 million liquid cash payout to the actual corporation. So the question then becomes, well, how do they use the rest of the CDA credit? Well, if there's any other assets that were in the corporation that were sort of stuck in there, maybe additional retained earnings from other years, that's an exit plan for those retained earnings. For any of the other capital that's stuck inside the corporation, any of the other assets, or any capital gains that have been triggered by passing the shares, those types of things, selling assets, all of those things, that can be really helpful to have that additional capital dividend account credit. So, moral of the story here, in this particular scenario, the secret sauce is, it's not a decision as to where you're putting the money, whether it goes in an RRSP, a tax-free savings account, an insurance plan, whether it goes in an IPP for our corporate, our business owners who are incorporated. It's what you're actually investing in that's going to be a big dictator as to what the right move is. Taking money, taking it out, putting it into an RRSP jail in order to invest it into something that is as conservative, maybe even less conservative than an insurance policy like the one that I'm sharing with you here on this episode, is actually not a great move because you're not going to see as much of the tax benefit as you might think in your mind. What you want that RRSP or that tax-free savings account to do for you is to allow you to grow income without it being taxed and sort of stunted along the way. Well, insurance policies do that for us as well. We advocate that any of your conservative fixed income bond-like investments that you're doing, I don't care where it is, it makes more sense for you to stuff it into a policy so that you're limiting your downside risk while maintaining about the same rates of return with all of the other benefits of a life insurance policy, including leverageability for retirement income tax-free and a tax-free death benefit, is a better move than taking assets inside, say, an RRSP and investing them into a balanced mutual fund or GICs or anything like that that's going to provide a conservative rate of return. So hopefully you found some benefit from this particular Wealth Secrets Sauce episode. My name's Kyle, and remember, you can reach out to us so we can review your situation and try to figure out what's the best move for you given your risk tolerance, given your runway, given your business, be it incorporated or otherwise, or any of the other specific details that matter when you're trying to figure out your personal or corporate wealth building plan. Reach out at canadianwealthsecrets.com/discovery and book a call today. If you've enjoyed the episode, do us a solid, share it with someone you know and care about, and leave us a rating and review on Apple Podcasts. We will see you in the next episode. Take care.